Welcome to the Resource Consumption Accounting Introduction Series Part 2. This presentation is the second in a series of presentations introducing resource consumption accounting and its principles, which are designed to create improved information for managerial decision-making and enterprise optimization. I'm Larry White, the Director of the Resource Consumption Accounting Institute. This presentation will give you an overview of RCA's 3 foundational principles. It takes about 9 minutes. A second webcast on the same topic will provide more details. Additional webcasts introduce you to the RCA model and will present a variety of RCA concepts and information. You should recall this slide from the introductory podcast, Part 1. I just want to remind you, resource consumption accounting takes its key principles from German management accounting methods known as Grenzplan Kostenrechnen, which translated directly means flexible cost planning and control. We call it GPK. Research by the Institute of Management Accountants confirms GPK remains in wide use in German companies and widely taught in German universities. RCA acquires additional principles and capability by integrating a strict form of activity-based costing where detailed process insights are needed. Resource consumption accounting creates an integrated economic model of operations for decision-making by first modeling operational resource flows throughout your organization and then applying cost. This improves its usability and maintainability. It becomes an operational tool rather than an accounting or finance control mechanism. Let's delve into the principles. RCA is based on 3 foundational principles. First is the principle of causality, or cause and effect. We use the term attributable cost, which was defined in the 1960s by Professor Gordon Schillinglaw as the closest you can get to full cost and maintain a cause and effect relationship. This is an important concept because in RCA, costs only change if the resource mix causally involved in the production actually changes. Arbitrary fluctuations due to volume and other factors are eliminated. Most confusion between cost and operations arises from a non-cause and effect allocation. The second principle is responsiveness. The vast majority of decisions are marginal or incremental. To accurately assess these, you must trace the fixed and proportional costs associated with the flow of resources throughout your organization. This is a little hard to conceptualize, so I'll show you a diagram in the second presentation that will clarify what I mean. Responsiveness provides the level of cost insight and divisibility to allow you to determine whether costs are avoidable or unavoidable for decisions, which is ultimately what you need to know. The third principle is work or process visibility. This was the primary principle of activity-based costing, and it is clearly important to understand how resources are used in their processes. However, over-application of this principle can make a very complex model. RCA uses the principle of work where it is needed to support routine decision-making or for short periods of time when resource analysis suggests a process improvement may be needed. The objective of RCA is to produce a marginal profit and loss statement that clearly shows the nature and characteristics of several contribution margins. Costs are assigned to the level of the organization responsible for avoiding the cost. Costs can be assigned to the individual product or service level, the product or service level group, product or service level line, or to the entire organization. Think about the job of a work or resource center supervisor. Their job is to increase efficiency, essentially creating excess capacity. They are probably not responsible for creating demand for that capacity, and you want to reward them for creating efficiency, not for creating non-productive busy work to cover up excess capacity. The principle of causality and responsiveness allow your operational resource flows to be turned into avoidable and unavoidable costs for effective decision-making supporting enterprise optimization. I hope you have some sense of what RCA is and are starting to get an idea about how it works. This list of benefits may seem a little premature at this point, but it should become clearer as you can continue your study of resource consumption accounting. RCA is focused on providing transparent, highly understandable view of the economics of your organization's operations. It tracks the nature of costs, fixed and proportional, and how this nature changes to provide highly relevant information for marginal and incremental analysis. RCA can provide detailed variance analysis for extraordinary cost control and visibility. RCA allows you to plan cost targets without distortions. Fluctuations in volume will not change unit costs. RCA supports product costing as well as costing on other dimensions such as customer or distribution channel, and allows a variety of margins to support profitability analysis. RCA provides superior information on your capacity use and correctly handles excess capacity costs. The principles upon which an RCA model is built ensure the model is highly functional for planning, forecasting, and simulation. There are no arbitrary allocations that complicate the calculations. The only blocks will come from real capacity constraints. This is the second in a series of presentations on resource consumption accounting. A second webcast, Part B, on this topic will provide more details on the principle. If it has piqued your interest, I encourage you to listen to additional webcasts as they become available to learn more about how RCA delivers the results presented in this presentation. They are sequentially numbered, and you will generally find listening to them in order to be your best approach. The next in the series is Part 3, an overview of RCA modeling. Please don't hesitate to contact me via the website, by direct email, or by phone to discuss RCA and the RCA Institute. Thank you.